Hello. We're still going to be talking about partnership accounting today. Like I said, this is going to be the last topic of the semester. So far for partnership accounting, we have talked about what the journal entry transaction are when we build a partnership, and what is how the impact on the ownership structure and ownership percentage when partnerships go through booming, growing, stabilize, and being stable, and then going downhills. And we experienced new partners buying in, become one of the new partners, and we experienced some they see about thinking and planning to leave. So anyway, if partnership continues like that, then keep existing, then nothing special we talk about. But every year, especially during this epidemic, a lot of small business went out of business, have to be closed for good. So partnerships, being small business, they are easily affected because they have different costs, and they cannot enjoy the benefits of big companies, right? That's a downsides. Don't draw as much attention as big ones. Never too big to fall, never too big to fail, we say. So this time we're going to talk about when a partnership goes down, right? Decide to go bankrupt. What's going to happen, and what do we do for partnership? I don't know how many people remember, but I remember about 8 years ago, maybe 9, maybe 10 years ago, around Chinatown or in Houston, in many places, you still see a place called a Micro Center, right? Not Micro Center, Circus City, something like that. Yeah. So do they still exist now? No, they went bankrupt. And I remember when I heard they announced the bankrupt, I saw a lot of those commercials in front of their store saying the liquidation, 50% off, whatever stuff. And I think last year we know that Toys R Us closed, at least in North America, closed its stores. And they were, well, it was not really a discount, I think. With a few friends, I went to Toys R Us trying to buy something, at a good price for the kids, but they are doing everything only 10%. What I'm trying to mention is you will notice that for every company, when they're going out of business, shortly before they go out of business, every company tries to sell stuff. And they have a term for that called liquidation. What the liquidation basically means that we are selling everything and indicating if they are selling at a loss, but not necessarily true. Liquidated, right? Liquidated. Basically, what do you do in liquidation? You want to sell your stuff for another piece of, you want to swap land for another piece of land. That's not called liquidation. What is liquidation? You aim for liquidity. What is most liquid? Cash is most liquid. So basically, liquidation means sales off your everything, collect the cash as much as possible, and then pay off your liability with the cash. And hopefully there is something left for you, right? That's what we talk about liquidation, selling off everything. Of course, in real world, it's not so easy. It's not selling like you sell stock, sell a computer, whatever, if you really talk about business, if you have old furniture, smaller ones, you have old furniture, you have computer equipments, some, depending on the industry, may have, for example, saws, chainsaws, different things, and it may have, if it's a nursery, they may have different plants, right? If it's a laundry place, I mean, they may have different like that clothes, I don't know, and laundry equipments. So what I mean is you're gonna know how to sell these. You're gonna know whom to sell these to. So it's not an easy job, and in business world, and you can think about. There's a specific profession called a liquidator. I don't know if anybody watched the movie Richard Gere and the Julia Roberts, right? Probably Richard Gere, who looks really like my next door neighbor. Remember, I think that one thing is it's an old movie, right? And I remember Richard Gere had his, I think the Lotus sports car and 5-star, penthouse, whatever stuff. And Julia Roberts was asking like, hey, what do you do, right, for a living? And basically Richard Gere says, okay, I buy different pieces of companies together. Basically, I buy those going bankruptcy and then sell them piece by piece, right? So his job is somewhat like liquidator already. It's a good job if you know what price to attach to those stuff and if you know how to move stuff really quick. So let's take a look at right. So let's take a look at this practice about the liquidation. Okay. So basically, the question is presented in a very simplistic way, but this is as we can see, right? All right. So this company had it's kind of a partnership had 5 partners, A, B, C, D, E. Okay. Upon the time of liquidating, their respective cash capital balance was 20,000, 10,000, 30,000, 30,000, 10,000. Okay. And we can see that their profit and loss share each is 20, 30, 10, 20, 20. So add up to 100%. And upon liquidation, the start, the incept liquidation, the partnership had a cash 20,000. Oh, that's looking weird. 20,000, accounts receivable 50,000, inventory 30,000, land 20,000, and the PP 30,000. And the partnership had a liability 50,000, and the respective capital balances we talked about. So total asset is 150,000, total equity plus liability is 150,000, and we are good, right? And we know what happens was the liquidator comes in. Liquidator first sold off AR, received 10,000 cash, right? AR value was 50,000, and sold out the inventory. Sold out the inventory for 20,000. Inventory had a book value of 30,000, so there's 10,000 loss. Land was 20,000, sold for 20,000. I mean, that's why a lot of people like buy those, right? Buy the lands. So at least they didn't lose money. And the PP had a 10,000. And those numbers are everywhere. PP had a 10,000 of net balance, and they were sold for 10,000 cash, and the book value was 30,000 net, so 20,000 loss, right? So if you think about it, let's not make sure a few things. One is that we know that liquidators have to pay themselves, right? So here's a 5,000 fee, and every money they collect, we know we call shareholders residual claimers, right? And why? Because you cannot share anything unless they pay other people off, put it simple. So whatever cash collected needs to be paid off the liability first. And the second, we can imagine that, like I said, why we call it a liquidator, because to liquidator, everything needs to be paid in cash. So if you're the liquidator, right, literally speaking, what's in front of you are the following things. One, cash. Second, non-cash assets. Those you need to sell and turn them to cash, hopefully as much as possible. And the third is liabilities. Those you need to use the cash you collected to pay off creditors. And then you worry about, hey, A, B, C, D, E, or whatever the existing partners, how much do I give to you? Give to them, right? That's it. And we can also see that we have to know that until a partnership sells off everything, paid off everything, then the partnership can be liquidated, can go to a bankrupt, right? Before that, although they are in the liquidation process, it's still a company. And if it's still a company, meaning that they still have income statement and balance sheet. If they still have income statement and balance sheet, meaning that every loss when they sell asset, if there's a loss for someone here, when they sell 50 worth book value AR for 10,000, they incur 40,000 loss. The loss should be proportionally distributed among all the existing partners, right? We have to be aware of that, all right? So let's do this and see how this thing goes. I had some format actually already. I just deleted because I need to work with people. But let me just come up with a format. Like I said, it's extremely important to have a workable format, okay? So I know what I'm roughly looking at. So here, let's first start off with A, B, C, D, E, right? A, B, oops, sorry. C, D, E. And what are their ratios? Their ratios are 20, 30, 10, 10, 20, 20, 30, 10, 20, 20. 20, 30, 10, 20, And we had to follow because every transaction affects capital balances. And after selling of everything, paid off everything, the remaining capital balances determines how much each partner will receive from the soon to be bankrupted company, the partnership, right? So we have just said also in front of the liquidator, there's only 4 types of things. Cash assets could be sold to cash for cash, could be turned to cash, and liabilities which will consume cash to be paid off so the company partners can avoid legal issues, and the equity, which is how much everybody, the partners receive after everything is done, right? So here we have the one of the parts, equity for everybody, right? And how much do they start with? Let's do I have merge cell somewhere? Oh, okay. Okay, definitely then. Right. So the respective balances here, we know that it's 20,000. So what is our purpose here, right? What is our purpose here? Yep. Our purpose is to figure out, this is liquidation. Like I said, after liquidation, how much should every partner get after liquidating, right? And what do we use to measure how much every partner gets? We use the capital balance we can measure. But this 20, 10, 30, 30, 10 is underlying, it needs one assumption, right? Is every asset is worth exactly the value is equal to the book value. Then we can do this, right? Here we can get 150,000, pay off 50,000, then you have the rest 100,000 for everybody. However, we know liquidation, cash of course doesn't change. AR, you'll be selling for less. Inventory might be selling for less. Land, I don't know. Then PP sold for less. So there's going to be losses, right? And no creditor will charge less. So in this case, we know for everybody, their share, the actual amount of balance will be smaller than what we see here. And our issue is how small those are, right? So to do this, we need to figure out, like I said, because every asset is potentially sold less lower than its book value, so incur loss. We need to figure out how it's affecting, and we also need to know from selling every asset how much do they have, right? So let's take a look here. Let's say cash. That's the first asset, right? And a non-cash assets. Okay, that's why I have 2 here. Then we have liability. Then you have liability, right? Then we have liability. Then we have those total loss, total gain, gain loss, gain loss from selling the asset. So let me show you. Like I said, a workable format is extremely important, right? It's really important. So cash, right before liquidation, they had 20,000 cash, and non-cash assets, those needs to be sold to cash is 130,000. If you add up everything here, 130,000. And then how much liability? Why we need to know this? Because we need to pay off liability, right? Otherwise, bank won't let you go and the shareholders won't claim anything, right? So let's talk about the impact of first transaction, which is setting AR, getting 10,000, and AR value was 50,000. Okay, so keep in mind, all right? So here what we have is after setting this, AR value, book value was 50. After you sold it, book value will be lowered by 50,000 because it's sold, right? By 50,000. And how much was it sold for? You can imagine a journal entry practicing. I said it was sold for 10,000 cash, right? And there's nothing touching liability. And here a loss is 40,000. We good? And this 40,000 here will be shared in what ratio? 4.